Welcome back to Money and Banking, everyone. We're going to continue our discussion of the behavior of interest rates. Now, in the last lecture, what we did was we described the behavior of the interest rate and we motivated it by looking at market determination of the interest rate. The market that we based this determination off of was buying and selling of bonds, right? So this would be the savings and investment equilibrium in the economy. Today, we're going to move into the liquidity theory of the interest rate, which is a theory developed by Keynes. It takes a different approach to the determination of the interest rate, but is effectively equivalent to the one that we just viewed in the bond market. Only this one will allow us to sort of more clearly see the role of central banks in the process, if you will. To start off with, let's try to make sure that we kind of understand the equivalence proposition between determination of the interest rate by equilibrium in the bond market and what we're going to be doing here, which is determination of the interest rate via the money market. So let's look at supply and demand in the money market. This is going to be how we take the Keynesian approach to determining the interest rate. This is called the liquidity preference framework. The Keynesian model that determines the equilibrium interest rate in terms of the supply and the demand for money. There are two main categories of assets that people use to store their wealth: money and bonds. Now, in reality, of course, there are many assets that individuals use to form their wealth, but we're going to make this simplifying assumption in order to make the model easy to look at. So let's just consider the amount of wealth in the economy as being essentially fixed, and then every individual has to divide their wealth up between money and bonds. Recall that money is useful, so it's nice to hold your wealth in the form of money because, of course, money is used for exchange, right? Transactions. And so there's a liquidity property of holding money, which is a benefit, and it leads to this demand for money in order to execute transactions. We call that transactions demand for money. Now, keep in mind, when you're undertaking transactions, there are two reasons essentially why you might think you need more money. One of them is if you're going to buy more stuff. So if income and GDP increases, you're going to need more liquid money in order to execute all those transactions. Another reason you might need more money is not because you're going to buy more stuff or because GDP or income has increased, but instead because things have become more expensive. So if we start to see the price level rise, if we see inflation, individuals will, of course, need more of their wealth in liquid monetary form in order to execute those transactions. So these are the transactions demand for money. We'll talk about it more in the future. But as we discussed in the previous lecture, something that should be very familiar to you now, money bears no rate of interest. And so you're losing out on accumulation of funds that you could have had you held your wealth in bond form. The interest rate, of course, being the attractiveness of saving or the attractiveness of holding bonds. And so we'll be looking at that tension and that competition through this lecture to find individuals' optimal allocation of wealth between liquid money and interest-bearing bonds. If we look at total wealth in the economy, it would be all the bond supply and the money supply equal to bond demand and money demand. This is all the forms of wealth that we have accounted for, and here we're assuming that wealth supply is equal to wealth demand, if you will. If we rearrange this equation, and of course we get the bond market on the left-hand side of the equation, we've got bond supply minus bond demand is equal to money supply minus money demand. And there's a lot of different ways that you can read this, but essentially the kind of quick one that we want to get to is that if money supply is equal to money demand and the money market is in equilibrium, then it must also be the case that the bond market is in equilibrium. So this statement says that using the Keynesian approach through the money market to determine the interest rate is equivalent to what we did in the last section where we looked at the bond market to determine the interest rate. So let's go ahead and dive into the money market in order to determine our interest rate. Now, here we're going to be looking at a market, and so you know it's going to have two components. It's going to have money supply, and our vertical curve is money supply. it's going to have a demand curve, and since we're in the market for money, we have money demand. That's the downward sloping curve, MD. On the x-axis, we have the real quantity of money, and on the y-axis, we have the price of whatever it is in the market we're analyzing, and that for the money market, of course, is the interest rate. Now let's go into the money supply and money demand curve just a little bit more deeply so that we understand them. You'll note that the money supply curve is vertical here, meaning, of course, that as the interest rate changes, the money supply does not automatically change. That is to say that the money supply is independent of movements in the interest rate. It doesn't matter if the interest rate is 15% or 20% or 25%, the money supply in this diagram is always 300 billion. That is because we're assuming that the money supply is determined exogenously to the model. It's determined by variables that are not shown here, outside the model, exogenous to the model. You can think of an exoskeleton of an insect. The skeleton's on the outside. So money supply here is exogenously determined. Well, who determines the money supply? We're going to assume that the central bank determines the money supply. And the central bank, at its whim, may increase or decrease the money supply, but it does not have to do so, when the interest rate rises and falls. It will do so for other reasons, other mandates that the central bank may have. So we're going to fix the money supply at 300 billion here, right? And it does not depend upon the interest rate, hence it's vertical, but we might see the money supply shift either right or left. If the money supply shifted to the right, this would indicate, of course, that the central bank had increased the money supply from, say, 300 to 400 billion in this case. If the money supply curve were to shift to the left, this would indicate that the central bank had reduced the money supply from, say, 300 billion to 200 billion. The money demand curve is downward sloping, right? Meaning that it is inversely related to the interest rate. As the interest rate rises, say from 15% to 25%, we ride along the money demand curve from point C to point B to point A, right? This is referred to as a change in the quantity of money demanded. And as the interest rate declines, of course, we move from C to D to E, an increase in the quantity of money demanded. Let's motivate this idea, right? Individuals have a fixed amount of wealth. They must decide how much of it to hold in money form, and that will constitute their money demand, and how much to hold in bond form. Money, of course, is valuable because it is liquid. Bonds are valuable because they pay an interest rate. As the interest rate rises, the opportunity cost of holding money increases, and individuals optimize their portfolio by holding less money and consequently more bonds. So as we're moving from D to C to B, people are reducing the quantity of wealth that they wish to hold as money, and they're transforming that money into bonds that pay interest. So as we're moving along this money demand schedule, you are seeing, right, changes in the quantity demanded of liquid money and consequently changes in the buying and selling of bonds, right? So individuals will balance out the utility from liquidity with the utility of interest earning here. And their optimal allocation between liquid money and bonds, or liquidity and interest payments, will be shown by any point along that money demand curve. That optimal balance between bonds and money changes as incentives change. In this case, the interest rate is the incentive to either hold bonds or hold money. As the interest rate declines, of course, the attractiveness of bonds declines relative to the benefit of liquid money, and individuals increase the quantity demanded of money. That should explain that portfolio optimization, as individuals switch between bonds and money according to the usefulness of money and the interest rate, should help you sort of understand why that money demand curve is downward sloping. Let's see how this market generates an equilibrium. And as you can see, the X marks the spot here is where money supply equals money demand. That can be found at point C. And what we have is a quantity of money of 300 billion and an interest rate of 15%. That will be our equilibrium value of the interest rate given the preferences of money demand and the existing money supply. But supposing that we were in a disequilibrium, supposing that we were operating at an interest rate of, say, 25%. We have a very high interest rate of 25%, and if we ask portfolio optimizers how much money they would wish to hold, well, they would report to us point A. And so the money demand would be 100 billion. But the money supply in the economy is 300 billion. And so we have an excess money supply. Money supply outstrips money demand. Well, individuals wish to hold only 100 billion in liquid money form, and there's another 200 billion out there that they do not wish to hold in liquid form. What will individuals do with all of that extra money supply that they don't wish to hold in liquid form? Well, they'll go and buy bonds. As they buy bonds, they will push up the price of bonds. And as you know, the price of bonds and interest rates are negatively related. So this will generate a decline in the interest rate. As the interest rate starts to decline, the attractiveness of bonds relative to money starts to decline, and individuals increase their quantity of money demanded, riding from A to B. Now, at point B, in an interest rate of 20%, we have exactly the same problem, money supply in excess of money demand. This will lead to the purchase of bonds and a further decline in interest rates. So long as there is a disequilibrium of the form money supply in excess of money demand, individuals will be purchasing bonds, bond prices will be rising, and interest rates will decline. This entire process will stop when individuals are happy with their allocation of bonds versus money, which occurs at point C. At point C, we see money supply equal to money demand, and buying and selling of bonds has now stopped. So we'll see an equilibrium bond price and an equilibrium interest rate, in this case at 15%. Let's, just for the sake of being exhaustive, do the opposite case. Let's take an interest rate of 5%. At an interest rate of 5%, of course, money supply is 300 billion. It doesn't change depending upon the interest rate. But if we asked individuals what their optimal allocation of liquid money versus interest-bearing bonds would be, they would essentially be telling us bonds are not very enticing relative to the benefit of liquidity of money because bonds aren't paying a very high interest rate. So we wish to hold most of our wealth in the form of money, and we wish to hold 500 billion in monetary form. However, there are only 300 billion available in the economy. So people wish to hold more money than is available to them, Where will they get the additional liquid money that they desire? They, of course, will sell bonds, transforming bonds into money. As they sell bonds in order to acquire the liquid money that they desire, bond prices will fall. As bond prices fall, interest rates will begin to rise. And as interest rates rise, of course, this changes the optimal allocation between liquid money and interest-bearing bonds, decreasing the quantity of money demanded. That process of selling bonds will continue so long as money demand is in excess of money supply. And so this process of bond selling driving up the interest rates will continue until we are again at point C, where individuals wish to hold the amount of money that is equal to the money supply. At this point, bond selling will stop, and we won't see any movement in bond prices. So we will have an equilibrium bond price and an equilibrium interest rate of 15%. That is essentially the dynamics of the money market that are at play and how we return to equilibrium. And so we see there is a way to motivate the equilibrium interest rate from behavior of the money market. Now, as we've done in all of our analysis of markets, we understand what's on the X and the Y axis. We understand the players involved. We understand what drives supply, what drives demand, and then we start looking at shocks to the system. So now that you understand the determination of equilibrium in the money market and how it relates to what's happening in the bond market that you just learned about, that should be going on in the background of your head as a mirror of this. Let's drive forward with the rest of the liquidity theory. Supply and demand in the market for money, the liquidity preference framework. Demand for money in the liquidity preference framework, well, it depends in part upon the interest rate. As the interest rate increases, the opportunity cost of holding money increases. The relative expected rate of return on money decreases, and therefore the quantity of money decreases. So that's movements along the curve, right? Interest rates changing, and we're seeing changing allocation between money and bonds in order to optimize according to opportunity costs. Let's talk about the factors that shift the money demand schedule. In fact, we've already introduced them to you in the first slide, but let's formally introduce them to you at this point. What causes money demand to shift? Well, that is going to be factors that cause individuals to, want more money independent of the interest rate. So the interest rate stays fixed. Something else changes in the economy that induces individuals to either want more money or want less money. Now, what could those factors be? We've discussed them, but they're listed formally for you here. One is the income effect, and another is the price level effect. Now, you remember, income, Y, and GDP are all the same, right? So the income effect. A higher level of income causes the demand for money at any interest rate to increase, and the demand curve will shift to the right. What that's saying is, at higher levels of GDP, at higher levels of income, we're going to be purchasing more goods and services, and we need more money for any given interest rate to execute those purchases. So the income effect says, hey, as the economy grows in real terms, individuals are going to want more liquid money in order to execute those transactions. A second way that individuals might want more money at any given interest rate is if the price level increases. This is inflation. A rise in the price level causes the demand for money at any interest rate to increase, and the demand curve shifts to the right. So GDP is growing, money demand shifts to the right. You enter into a recession, GDP is falling, income is falling, people are undertaking fewer transactions, money demand shifts to the left. If you see inflation or the anticipation of inflation, right? There's two different kinds, actual inflation and expected inflation. Individuals will want more money, and of course the money demand curve will shift to the right. If there's expected deflation or actual deflation, well, goods and services cost less money. Why would I be holding all this money around when I could earn interest on it in the bond market? And the money demand schedule shifts to the left. So these are the shift factors for money demand. Now you've got everything you need to know about money demand. You've got the motivation of what causes us to move along the money demand schedule, a change in the quantity of money demanded, and that, of course, is motivated by movements in the interest rate as individuals respond to these changing incentives by shifting their wealth portfolio between liquid money and bonds. And now we've got our shift factors, essentially transactions demand, motivated by income and or price level effects. Income effects being, of course, a real shock. This is economic growth or economic recession. And price level effects being a nominal shock, being inflation or deflation. We've already discussed the things that cause money supply to shift. And of course, we said, well, we're assuming that the money supply is controlled essentially by the central bank. In the United States, of course, that central bank is called the Federal Reserve. An increase in the money supply engineered by the Federal Reserve will shift the money supply curve to the right. This would be an expansionary monetary policy, right? This would be loose monetary policy. This is an expansion of the money supply, shifting the money supply curve to the right. Of course, we could have the Federal Reserve undertake a contractionary monetary policy stance, reducing the money supply, and of course, shifting that money supply curve to the left, if you will. And so now we can more clearly see how monetary policy can play out in this model, whereas in our bond market, we would have to introduce the Federal Reserve buying and selling bonds in order to determine changes in the interest rate. Can be done, but here it's just a little bit more clearly stated to you, right? So we're having a focus on monetary policy motivated in this liquidity preference framework. We have a nice summary table here, which essentially just outlines everything that we just spoke about, right? We have the variable in the first column, the change in the variable in the second column, right? The change in money demand and or money supply in the third column, and then the change in the interest rate as we squirm towards a new equilibrium. A boost in income, right, is going to shift the money demand schedule to the right, and this is going to open up excess money demand, causing us to see a sell-off of bonds. Bond prices fall and interest rates rise. That same scenario could be motivated by a change in the price level. Exactly the same scenario, exactly the same description. When we see the money supply increase, we see that we've created a disequilibrium in the money market. That money market is excess money supply. People have more money than they wish to hold as money. So what do? They go and buy bonds, driving up the price of bonds and, of course, driving down the interest rate until we reach a new equilibrium. So this is the summary table. Keep in mind what's happening in the bond market in the background, right, so that you fully understand the symmetry between these two markets. In this slide, figure 9 in your text, we're really just reiterating what we just said, right? So let's do it slowly just to make sure that it's deeply embedded in you. We start off at an equilibrium at point 1. The interest rate is I1, and the money supply, of course, is fixed. Money supply is equal to money demand, our two initial curves. The two blue curves are crossing there. Now there is some sort of a shock. In this case, the shock is a rightward shift of money demand, and it is motivated in this case by a rise in income. It could also be motivated by an increase in the price level. Either one, they're the same, generalized way of analyzing this, right? At interest rate 1, we no longer have an equilibrium. Money demand is now in excess of money supply. We have a disequilibrium. People wish to hold more money than is available to them. Where are they going to get the money? They're going to get it from selling bonds. So they sort of transition their portfolio of wealth, reducing the bond component in order to increase the money component. As they do so, the price of bonds decline and interest rates rise until we have again reached equilibrium. That equilibrium is at I2 and at point 2. So a change in income or a change in the price level will push interest rates up. Figure 10. Response to a change in the money supply. Let's again find our initial equilibrium where the two blue curves are crossing. That is at point 1 and at interest rate I1. Money supply is equal to money demand. And then, of course, there's a disturbance or a shock that generates a disequilibrium. In this case, the central bank has decided to increase the money supply from MS1 to MS2. This causes a shift rightward in the money supply, opening up a disequilibrium at the old equilibrium interest rate I1. I1 is no longer in equilibrium, right? In fact, now that we've seen this change in money supply, I1 leaves us at a disequilibrium where money supply is in excess of money demand, right? There's more money out there than people wish to hold as money. What do? Well, they buy bonds with it, and as they do so, they push up the price of bonds, causing the interest rate to decline. As the interest rate declines, it increases the quantity of money demanded because, of course, it reduces the attractiveness of bonds. This process will continue until people have stopped buying and selling bonds, and they're happy with the amount of bonds and money that they are holding. This occurs where money supply is equal to money demand, and bond supply will be equal to bond demand in the symmetry market, right? And this occurs at an interest rate of I2. So what we're seeing here is that at least initially, right, if the central bank wants to lower interest rates, it will increase the money supply. And if it wants to raise interest rates, it will decrease the money supply. But there are secondary effects. We want to talk about that now. Money and interest rates. A one-time increase in the money supply will cause prices to rise, and they will rise to a permanently higher level by the end of some period of time, maybe a year. The interest rate then will increase via the increase in prices. So you jack up the money supply, it generates inflation, that causes to see a price level effect, shifting money demand out and putting pressure upwards on interest rates. A rising price level will raise interest rates because people will expect inflation to be higher over the course of the year. When the price level stops rising, expectations of inflation will return to zero. They'll say, okay, we've had inflation of 3%, let's drive up the interest rate to 3%. Once that inflation is absorbed, then of course we don't expect future inflation to continue. So we have this price level effect, and we also have the expected inflation effect. It persists only as long as the price level continues to rise, right? As long as there's more inflation to expect in the future, right? So we might think, right, that an increase in the money supply would press us to permanently low interest rates, but the price level effect and the expected inflation effect say there's countervailing forces in the economy that are not pressing the interest rate down with the increase of the money supply, but are pushing the interest rate back up through the price level effect and inflation effect. Does a higher rate of growth of the money supply lower interest rates, which is what we would expect from our first analysis of the liquidity preference framework, right? Liquidity preference framework leads to the conclusion that an increase in the money supply will lower interest rates. We call this the liquidity effect. Yeah? More liquidity, lowering interest rates. The income effect, right, finds interest rates rising because the increase in the money supply has an expansionary influence on GDP, right? So increasing the money supply, lowering interest rates, generating more business investment and more economic activity, which pushes up GDP and income, which in turn shifts the money demand curve to the right. So the liquidity effect is arguing for lower interest rates. The income effect is pushing back against that, pressing interest rate. As we've discussed, the price level effect and the expected inflation effect will also be working in the opposite direction of the liquidity effect, again, pushing interest rates up. The overall question as to whether or not an increase in the money supply will permanently lower interest rates depends upon the relative strengths of the liquidity effect versus our income, price level, and expected inflation effects. That makes sense because they're both forces pushing in the opposite direction on the interest rate. Whichever one is stronger, more durable, is going to win the tug of war, if you will. So there's no unique thing that you can say, which is that, money supply increases will always permanently lower the interest rate. That may be true in some eras and in some environments of, income, price level, and expected inflation effects. And it may be very false, where income, price level, and expectation of inflation effects are much stronger in the economy. So it depends upon the landscape where this expansionary monetary policy is operating. And to sort of clearly, sort of lay that out for you, we have our graph figure 11, which is the response over time to an increase in money supply growth. In our first sort of model here, what we have is time on the x-axis, and that's true of all of our panels. We have the interest rate on the y-axis, and that's true of all of our panels. And so we're saying, hey, what happens to the interest rate through time? Now, what we're going to be assuming is that there is a shock to the money market, and that shock to the money market is an increase in the growth of money supply. In our first diagram, what we're seeing is that the interest rate falls, and that, of course, is the liquidity effect, increasing the money supply, driving down interest rates. But at some point, that decline in the interest rates bottoms out, stabilizes, and starts to be reversed slowly, right? That pressure downward on the interest rate is being pushed back up, right? And that is the income, price level, and expected inflation effect taking over after expansionary monetary policy has worked on the economy to start to level out the interest rate, pressing it up higher. In this first panel, the liquidity effect dominates the other three effects, and we do see lower interest rates even after all of them have been accounted for. In our second panel, we see the same thing initially, an increase in the money supply, driving the liquidity effect and pushing interest rates down. They bottom out, the economy begins to grow, income expected, inflation, and price level effects start to take over, pressing the interest rates back up. And in this case, those latter effects dominate the liquidity effect in order to leave us at a higher interest rate than before the economic expansion was triggered by the lowering of interest rates. In the third panel, the expansion in the money supply leads almost directly to higher expectations of inflation, higher actual inflation, or strong, robust economic growth causing more transactions to take place. This is a very tight economy, right? That is probably already operating relatively close to capacity, such that an expansion in the money supply is being viewed as overheating the economy and generating, unsustainable growths in income and long-range growth in the price level and expectations of inflation in the near term as we move towards that price level, right? And so what we see is the expansionary money supply has no lowering impact on the interest rate because we're already at the wall, and expectations of higher price levels immediately dominate people's expectations, driving an increase in money demand to absorb all of that extra liquidity, right, and press up interest rates. So, will monetary policy effectively lower interest rates? Well, it depends on really where the economy's at the time. It's likely that the first panel will dominate in a deep recession or a depression, yeah? And it's likely that the last panel will dominate if the economy is already operating at capacity or full employment and, price level expectations are very tight, if you will. Figure 12 is money growth, M2, right? This is our broad money, not M1, but M2. And it's an annual rate of growth. So this is the rate of growth, right? An increase in interest rates on 3-month Treasury bills from 1950 to 2017. Now, if the liquidity effect is dominating at any point in time, then what we should see is an increase in the growth rate of money leading to a decline in interest rates. That's certainly something that we do see around, looks like the late 50s. We see high monetary growth through the early 60s. And with that high monetary growth, we're seeing a steady rise in the interest rate. We see a growth rate of the money supply in about 66 and a slight decline in the interest rate. But then, of course, the interest rate starts climbing again, even while money growth is very high, suggesting, of course, that our income, price level, and expected inflation effects are starting to dominate. About 1975, the money growth rate declines, and as we see rising interest rates associated with that, which would be our liquidity effect taking place. Yeah, we see a decline in the money supply through the late 70s and 80s, and a rise in the interest rate. Again, something we would expect from actually all of our effects, right? A reduction in the money supply driving up interest rates. Do note also that through the 70s and 80s, we were dealing with double-digit inflation in the United States. And so expected inflation and actual inflation, these price effects, were quite strong. And these, together with the reduction in the money supply in the late 70s, help to explain why the interest rate is rising. Moving into the 90s through 2000, right, we see generalized strong growth in the money supply and interest rates declining up until about 2006 with the Great Recession, when inflation expectations started to dominate what was happening with the liquidity effect. We've then seen heavy central bank intervention, right, in order to maintain rock bottom interest rates from about the Great Recession on through the COVID pandemic. I hope you guys have enjoyed this lecture, and I hope that everything about this liquidity theory from Keynes was presented to you in a clear manner, in a slow enough manner for you to really absorb it. I wanted also to make sure that we weren't just learning a new theory, but that we were also reinforcing our previous work that we had done in the bond market, so that you can again see the relationship between these two forms of analyses. Do make sure that you focus not only on being able to explain how shifts in money demand and money supply are motivated, but also how we restore to equilibrium. Also, do keep in mind our figure 11, right? We've got differing cases about the effect of the money supply on interest rates. Are they permanently lower? Are they slightly higher? Do we see an increase? Right? So make sure that you understand those forces that are at play as we move into doing homework and exam questions and the like. It's a much more sophisticated analysis than what we might have motivated simply from our views of the bond market alone. In any case, we'll be moving forward, and I hope that you enjoyed the presentation. Have a lovely day wherever you are. Bye-bye.